You are now listening to The Big Trade with Peter Pham, enlightening conversations for maximum market returns.
So, Jack, why don't you tell us what you're up to these days?
Okay, so currently I'm a partner in a company called Fundseeder. The site is fundseeder.com. And basically what the site is designed to do is to connect undiscovered trading talent with investors who are interested in finding undiscovered trading talent. So we're sort of the middleman in that process. And the idea really was not mine. It was my partner, Emmanuel Bellari, who was an associate of mine from a previous venture that I was involved in. And he had this idea, and he had tossed it out to me a couple of years ago, and that's what I thought. And I said, "Gee, it sounds like a really good idea." So I agreed to join him on it. It's really his primary. He's the primary mover on it, and it was his original idea. And he's the CEO, and he's the one who's really doing the bulk of the work. But I'm basically involved in terms of helping design the site, how it works, and involved with traders and so forth. So basically, that is my current involvement. This is fundseeder.com. And the other element of it that makes it, I think, somewhat unique is that it not only tries to connect undiscovered trading talent with investors, but it verifies the track records. So we don't just take traders' track records and post them like a lot of sites do. What we do is we get them to agree to have us download their daily downloads of their records directly from the brokerage firm. So that verification process, I think, is a very critical part of it.
How many users are currently using Fundseeder?
I just spoke to Emmanuel today, and it's a little over 4,000.
Jack, I know they have a lot of stock market related contests and games and also similar ones where somehow you could obtain a certain individual's performance and then have some of your funds co-managed by them. What stops, when you do a ranking of the performance of these investors or traders, what stops one from taking unnecessary risks to obtain outsized returns? Because typically when you look at some of these contests or platforms like this, you're going to see guys that are going to get 1,000% returns, and probably you could equate that to a lot of outside risk. And then how do you filter those guys doing kamikaze versus guys that are genuinely good and have a consistent record?
Yeah, that's an intelligent question. First of all, the algorithm we use, and we have a number of statistics on the site, but the main algorithm that ranks it is a proprietary algorithm that is relatively sophisticated. I did not develop it. We have a mathematician who's our CTO, and it's his work that's behind it. But essentially, I guess I understand enough math to understand roughly what he's doing. But it does take into account, it does look at, analyzes distributions and looking for returns that the signal when returns are likely part of a martingale approach or an outside tail risk approach or whatever. So the distributions will have certain features to them that will, even though the large loss may not have shown up, it will still be sort of implicit in the type of distribution. The middle portion of it will look different than it would for normal traders.
Jack, why don't you give me your best case argument for why markets are not efficient?
I have a book which is actually one of my lesser read books because it's not a Market Wizard book, but it's called Market Sense and Nonsense. And it was originally the first chapter, but I moved it to the second chapter because it was too long and maybe too rough of a start. But I actually filled a fairly good-sized chapter with all reasons of why the markets are not efficient. So I'll give you just some off the top of my head here, and there are multiple reasons why the markets are not efficient. So you can do an empirical approach where you can show that one common mistake people make is they say, well, yeah, you get people like the market wizards, some of these guys, but they're just the lucky ones. You have all these guys that are going to lose, and if you have enough traders, some of them are going to really do well. What they miss on that is, that is true, but how many traders do you need to get a Thorpe? And so, like, you would need not only trillions, you would need trillions is like, 10 digits or something. You need like something with 60 digits to it to get a Thorpe by chance. So there are people who have track records out there that are mathematical impossibilities, not improbabilities, but mathematical impossibilities. If the markets were rare. So you have a empirical demonstration that there are people who clearly have records that could not have been compiled, even no matter how many traders you want to assume. Even if everybody on Earth was a trader and there were a billion times more traders than there are people on the Earth, you still couldn't get those records. So that's the empirical argument. Mm-hmm. Then there's the important argument, another empirical argument, you have the markets themselves. So the Fisher market hypothesis, assuming the prices sort of randomly distributed, that type of kind of model of the markets completely falls apart when you get something like October 87. October 87 is actually even more improbable than Thorpe's track record. So I think I used the analogy that, and I had Wolfram. The website actually answered the question of an estimate of how many atoms there are in a universe, visible universe. That's the only reason I was able to do it. But it turns out that if you do the same thing with the October 1987, if you took a random atom in the visible universe and repeated the process, picked the same atom, that's the probability in standard deviations of the October 87. So you get empirical things that are just couldn't happen if the markets were efficient. Then you have things that are you have to be blind. Or you have to be very dogmatic. You have to be really dogmatic to continue to believe in the Fisher market hypothesis when you see things of this type. There's millions of examples, but let's take really a very prominent one, the internet bubble. So you have these stocks, they go from 5 to 200 or whatever it may be, and they go all the way back to zero again. The internet index itself went up by, I believe, sevenfold in 1.5 years, and then in virtually perfect symmetry, went all the way back down to where it came, which was like an 85% decline, in the next year and a half. So a year and a half, it went up like 7 times and gave it all back in the next year and a half. And believe me, there was nothing dramatic that happened at that turning point. It was just that the only way you can explain that, you can't go to the fundamentals. You had companies that were losing money all along. You couldn't even talk about multiples because there were no earnings. There were never any earnings. So you had companies companies that were only burning cash, go to these ridiculous numbers and then go all the way back and go bankrupt. So you can understand why they went bankrupt, but you can't explain through the Fisher market hypothesis that the market was taking known fundamentals and discounting them. You can't explain the rise. You can only explain You can explain the rise only by euphoria and emotional human behavior, and the decline you can explain by the fact that emotional behavior took prices to ridiculous levels, and then the thing collapsed. So you don't need emotion necessarily to give you the collapse, but of course that builds on it too.
So you're saying bubbles, basically.
Bubbles, right? Okay. So all bubbles are a demonstration that the markets are not efficient. So here's the thing. The efficient market hypothesis would like to have a nice, simple mathematical model with normal distributions and everything falls into place. Everything, all the math could work out nicely. But that's a model. It's not the real world. The real world is described by the efficient market hypothesis model some of the time and in broad terms. But what's lost is that the markets are not just a random process. You also have human behavior. And human behavior causes extremes. You get extreme emotionalism. It's happened throughout history. And so any model that you have that doesn't incorporate human behavior is just wrong. You're missing one of the key elements. So I like to say that markets, big price moves, big bull markets, or begin on fundamentals and they end on emotions. So there's a time where, the fundamentals are describing why the market's going up, but then it goes way beyond there. And why it goes beyond there is not because the fundamentals are getting more and more bullish. It goes way beyond there because of human behavior. And you can't predict. It's like there's a bit of chaotic behavior to it. In other words, you can take the exact same situation, and in one situation, let's say like we had the NASDAQ go up to 5,000. I'm totally convinced that if you had sort of parallel universes and ran the same experiment, they were all the same things. One time you might have to, go up to 5,000, another time you might have to go to 8,000, another time you might have to go to 3,000. I think those things are not predictable. I think there's a certain amount of randomness in how far the emotionalism carries. And small tiny changes in certain things could result in big differences maybe in how far the extreme goes. It's not a predictable thing. And that's what drives people to efficient market hypothesis, because can't deal with that unpredictability that you really can't predict it. You can't say how far is human behavior or human emotion going to go. But if you ignore that that's what's driving the market, you will have an incorrect model of how prices behave.
Sure. Okay. So we have basically statistics of traders that have been able to be successful in markets and
but not only successful, but ridiculously successful in a return risk measure. Okay.
And then we have basically bubbles and busts, which is another indication. What else do we have on this list, Jack?
Then you have this is sort of, you get to the logical misconceptions. So you have this idea, I don't know how many people have written articles or academic papers even saying, well, if the markets weren't efficient, how do you explain the fact that so many, you take all these managers and the average manager does worse than the index, that type of sort of proof. So, if the markets were random, then the markets couldn't be beat, right? And then they say, so therefore, since we're showing you that the markets can't be beat by all these managers, average not beating the index, therefore the markets are random. And that's a flaw. That's a flaw in logic.
Circular reasoning.
It's converse. It's assuming that the converse of a statement is true. If a statement is true, the converse is true. So, for example, what I used in the book, I think, was the example of you could say that all polar bears are white mammals. That's true, right? Mm-hmm. But not all white mammals are polar bears.
Yeah,
that's exact same type of logic that they're using. So yes, if the markets were efficient, the markets, you couldn't beat them. But showing that all these instances where the markets are not beat by simple systems or managers doesn't prove that the markets are, it's a flaw in logic. Doesn't prove that the markets are efficient. Then there's this misunderstanding about everybody has the same, all the information is known at the same time, right? Mm-hmm. So that's also, if you think about it, it's a little imbecilic. In a sense that sort of an example I use is think of a chess tournament, right? I mean, everybody has all the same information. Everybody knows how the pieces move. Everybody knows, has read all the same chess books. Everybody knows all the same, information, has all the same information. But then you'll have chess, certain people like Kasparov in his heyday who will crush the competition. It's not because they know more; it's because they're more skilled in using the same information. Mm. And it's like anything else. Just because everybody has the same information doesn't mean that everybody will use that information the same way. That's why, the people I interviewed, that information that they used. Well, I talked about Taylor with Apple. Everybody had the same information on Apple, presumably. He didn't have any secret sources telling him what was going to happen with China, but he was well informed from information that was out there and took it to its logical conclusion. It's not that he had any secret information. He just interpreted that information more efficiently. So the idea that just because all information becomes disseminated instantaneously and everybody has the same information, therefore nobody can get an edge, is ridiculous. It's like saying, like I say, it's like saying that everybody in a chess tournament should have an equal chance of winning because everybody knows all the same rules and historical games.
Can you basically say something like all information is known, but it's the focus on a particular set of data that's what makes it important?
I don't know if the focus part of it. Part of it is you
like, because he
focus
said
on
China, right, for Apple, so that was his focus.
That was, so he knew which point to pull out. He knew which single point to pull out. Yeah, an example I talked about Marcus being able to, the thing that I always remember is back in the years when I was just a research analyst, and when I first met Marcus, in fact, it was his job that I took. He left to become a trader. And so I would, I came from an economics background. I would do these fundamental models. I remember on a cotton market, I went back and I researched every single post-World War II year in the cotton market. And I came to the realization that there were only about three or four markets that were free markets, because in all the other years, the government loan programs were basically supporting the price, and you really couldn't tell where the equilibrium was. But based upon that, I came up with sort of, we were looking for a tight market, and I came up with another year that was closest to it, and it looked like this was going to be as tight as that, and therefore the market was 25 cents. I said, it should be able to get to the same as through the other year, which was like mid-30s or whatever. So that was my projection. And so that was right. And the market got there. But then I thought, anything much beyond that is going to be overpriced. Marcus understood that was the first year that was then China was called the PRC. That was the first year that the PRC was a major buyer in the cotton market. And, I was looking at a whole bunch of fundamentals and everything. He just looked at that one thing. He understood that the PRC coming into the market changed the game entirely. It would go way higher, way higher. Actually, cotton that year tripled, and that was one of I was just early in the market in the first couple of years, and I remember I had like a $2,000 or $3,000 account, and I made a little money, but that little $2,000-3,000 account got wiped out on the cotton trade.
That's interesting.
I was right about it at the beginning, but eventually, but I was so wrong. And it's a good thing I only had $2,000 or $3,000, because I could have lost a lot more, because I didn't understand risk management at that point yet either. So
that's very interesting, by the way, because the PBOC now is playing even a larger role on futures and commodities right now, even surpassing the volumes of New York and like London and Chicago as well.
Yeah, there's certainly an important element now.
Yeah,
so.
yeah.
But in that case, they were there's a completely new element.
It was a new thing,
The thing was that he understood there was a new factor in the market that you couldn't find in history, but he understood what the significance of that factor was. Again, so like you say, it's focusing on the right part. Now, other people may have known about PRC, but they didn't understand, including me, didn't understand the significance of it.
Well, if you watch like the news or something like CNBC or read the news wires, you'll actually see that it will be information we already know, but they'll say, well, XYZ stock is down because of this, right? Like, so it's Amazon's margins are getting more thin. Well, we already know that. And that's why the stock is down. So to me, it seems as if the news cycle, which tries to explain to some extent about price behavior, shifts its focus on whatever is the hot topic of that time.
Absolutely, and it's even worse that people think that the financial whatever you want to call them, news networks or whatever, that they're giving the fundamentals of why the stock or the market or a particular market or the market as a whole moved. That's not the way. That's the wrong cause and effect.
Right.
The market move determines what news is they give you.
Exactly.
So if the market, if Amazon is up on a given day, they'll dig up something that's bullish about it, whether anything happened or new or not. If it's down that day, they'll dig up something that's bearish, whether anything happened, because they have to have an explanation. But markets don't work that way. Markets discount. They overreact. The markets don't work. That's sort of the efficient market hypothesis model, where you think that the way markets work is every time there's a new bit of news, the market moves, and that's the only way markets move. Baloney, that's not the way markets move. I mean, okay, sure, there's some really new news, it'll impact the market, but that's the rare exception. Most times nothing's happening that's really new, and it's just the market behaving based on the combination of known fundamentals and human behavior, and it's a mixture of those two. So I've seen days, in fact, in that Market Sense and Nonsense book, I put an example in. On the same day, I was looking for that while I was writing the book, but there was one day where the market, Bernanke, I think, had given a talk, and I don't remember if it was bullish or bearish for the market. This does not make any difference. But let's, for argument's sake, say that his comments were viewed as being negative. So the market was down. So early in the day, you had the news wires reading, market down, and Bernanke's, comments, blah, blah, blah. And then the market turned around and finished strong today. And the same newswire had a story, market up because of Bernanke's comments.
Right.
The same, it wasn't like an even different newswire, the same newswire. And this happens all the time. So it's laughable, actually.
So, Jack, is there anything else on that list of
Yeah, there proofs? Are. I'm sure there are others that I probably that I have. Let me see what we talked about the fact that I use the analogy, and this is part of what we talked about, the missing ingredient. I use the analogy of like I showed a recipe for chicken soup, and there was one ingredient missing, which was a chicken. And my point there was that the efficient market hypothesis is like a chicken recipe soup without the chicken, because it's missing a key element, namely human behavior. But we talked about that. That's a useful way of considering it. There was probably still some other things that I had. So looking at it from a rounded sense, though, I think it's hard to look at all of those facts and continue to believe that the markets are efficient. It's
right.
I mean, I don't know if evolution is a hypothetical theory or not true. If you have deep-seated religious beliefs and you don't want to be confused by science, I guess you could do it, but you can't do it if you're willing to look at facts.
So Jack, you're also a well-known author for the whole Market Wizard series. I can proudly say I have a majority of them and read a majority of them. I think that the little book of Market Wizards is my least favorite out of them because of the substance in which, some of the original, I guess the first three had. They're vastly much more thicker with tons and tons of more anecdotes and stories and insight. I guess my question would be is, based on all of these conversations that you had with all of these guys, what are some of the key things that traders and investors should take into consideration?
Yeah, that's always a question I get, and always a hard one to answer because when you think about it, really, those thick books that you mentioned are really the answer to that question. And any answer I give is always woefully, tremendously inadequate and leaves out, if I give 2 or 3 points, I'm leaving out 97 others.
Yeah. I always felt as if those original thick ones, say they were for very advanced, and then that little book version was for very beginners. Yeah, well,
basically, I mean, the little book of Market Wizards is not the same. It shares the Market Wizard part of the name, which is the letter, of course, obviously. But it's certainly a different type of book, and always was promoted for what it was, which is basically a distilling of the key points from the other books. So obviously, there were 4 other Market Wizard books, which I guess about 3 of them are about 500, maybe one's a little shorter, about 300. So you're talking probably maybe 1,800 pages of text. So you're distilling all of that down into, and the little book is kind of little, not only in its length, but also in its dimensions, its physical dimensions. That's a John Wiley series, the little book. They have the whole idea that it's distilling down larger volumes or the key points of larger volumes into smaller books. That's their theme. But in any case, a little book is also smaller dimensionally, so we're talking maybe the equivalent of 100 pages of the other books.
Right.
So you're talking going down from 1,800 to 100. So obviously it's not going to capture everything, but what I was trying to do with the little book is 2 things. One is I wanted to primarily, as you correctly pointed out, is capture the more novice layman audience. And That book is written in a way that anybody, you don't have to be a professional trader. You don't have to be a mathematician. You don't have to understand risk analysis in a deep fashion. Virtually anybody can basically get that. It's written sort of in I think, an easy narrative style. The other books are basically intended not purely for professional traders. I think also for even novice traders who are very serious, but they're much more serious. Those other books will get into much more detail about trading strategies, and will have terms that may be a little foreign to just a lay reader. Although I've always tried to explain things in bracketed form and in footnotes and whatever, so anybody who's serious will always have the information in the text itself without being sort of lost. But they are of a kind of at a higher level than this little book. And the little book is also intended as just a kind of note. It's almost like the cliff notes of the other books. So if you read the other books and just wanted to get just be reminded of the key points, you could read the little book and sort of get the essence of the other books. And maybe I won't pick out every single point you would have picked out, and not every highlight you would have picked out. But I bet that I will get a lot, that little book captures most of what people would highlight in the other books.
I don't know if the word cliff notes would be fair for that. I mean, I was actually hoping for it to be like the cliff notes. I wanted it to convey the essence of each individual, but I know that would be next to impossible, right? So
I wasn't trying different goals. See, in the original Market Wizard books, I was very, very much trying to convey the essence of every trader. And insofar, and my favorite thing was when I would meet people who worked for the traders, says, boy, you really got him right on. So that's great, because that's what I was trying to do. I was trying to capture each trader, their foibles, their mannerisms, the atmosphere, anything I could, really, just not only to give the information, but also to give almost a tactile feel for what the interview was like and what the person is like, as much as I could. So that was very much part of the goal, was to capture the person as well. In the little book, that was not at all the goal. In the little book, I wasn't trying to capture the person. I was trying to capture the key points of their advice. So right. It's a bit different, yeah. So I wasn't trying to capture any of the color, any of the capture, because then it would no longer be an old book. If I tried to do that,
right.
Then you so it was a different goal.
Because, some of these guys, when you're reading, I found myself rereading like pages or even just sentences within like some of the original Market Wizard books. And I'd imagine that it would be an extremely difficult job, actually, to capture the essence of everyone to some extent.
The difficult part in doing these books, and people really have a misconception. People think you just turn on a tape recorder and you do the interview and you have the book. And it's really a very, very distorted perception of the process. The truth of the matter is that these interviews go on for quite a while. And I've had instances where, I've interviewed a person over a period of 2 days or three separate 3-4 hour meetings. It varies with each person. But there's a lot more material than is on the page. And like all audio interviews, if you transcribe them purely straight to the page, they're not going to read very well. And you'll have people talk differently than they write, and so you'll start sentences and you'll go off on tangents upon tangents, and it just doesn't read well at all. And then you have a lot of, also when you're doing these interviews with traders, particularly, and you have to get over the reticence of what they're going to talk to you, willing to tell you and all that. You get a lot of stuff that's just not terribly, you have to go through stuff that's not terribly interesting sometimes to get the stuff that's interesting. Mm-hmm. I mean, I can remember interviews where I would spend 3 hours not getting anywhere, and it wasn't until the 4th hour until I started getting stuff that was useful. So the trick is basically to extract the good, the real worthwhile stuff out of a lot of material.
Right.
And so people mistake me for being a good interviewer. I'm not a good interviewer. I'm a very good editor. It's a difference.
In terms of like all these Market Wizards, who's influenced you the most from a philosophical standpoint and then from an investing and trading standpoint?
Gee, I don't know if anybody's influenced me in a tremendous way. I mean, I can think of, in terms of influence, I guess what is the most influential advice when it comes to as far as any trading would be, and other people said it too, but the one who said it most explicitly in a way that really stuck in my mind was Bruce Kovner with the advice of always know where you're getting out before you get in. Which to me, if I was forced to only be allowed to give one word of advice to a would-be trader, if I could only have one element of advice, I guess that would be one. I know it'd be hard because it's got to be more than one. One isn't really enough, but I consider that one of the most important pieces of advice that can be given or taken, and important because the Achilles heel for most traders will be losing too much on any given trade. Mm-hmm. Anytime I've violated that rule, I've regretted it. And it's also important because it captures the reality that you have complete objectivity only before you're in a trade. That's why decide where you're getting out before you get in is so important. So it does both of those. It sort of limits the damage that you can get on any single trade, which is absolutely critical to trader survival. Mm-hmm. And it forces you to make a decision of where to exit before you get in, or at least have a plan on where to exit before you get in. And that's important because it has you making that decision in a rational rather than emotional way.
So diving into that statement. Yeah, sure. So diving into that statement, what approach do you find to be the most effective for setting this stop loss?
Well, obviously the easiest thing to do is simply pick a literal stop point, put a good till cancel stop in, and you could rate, you can bring it in closer if the market goes in your favor. Mm-hmm.
But using what methodology, Jack, in your opinion?
That depends on what your methodology is. So the key here is you have to pick it, and I think Bruce Kovner said this, I'm paraphrasing him, mm-hmm. You have to decide where the market should not go if you're right? Mm-hmm. So, and depending on what your approach is, there's different ways to decide that. So if you have some sort of technical approach, systematic approach, you'll have a mathematical answer to that question. If you're a discretionary trader, you'll have another answer. Now, at what point the market shouldn't go? It could be a million different ways. It could be, like I say, it could be some sort of technical points. It could be a technical support level. It could even be simple as some sort of moving average crossing down below a certain point, or it could be something like, the market's last relative low was made on important news. The market shouldn't go back to that point. It could be anything. It really depends on what your approach is. But the key is you decide where should the market not go if I'm right. And once you decide that, that's where you put your stop. And once you know where your stop is and you know how much you're willing to lose, that will define your position size. Which is another important point, by the way.
Yeah, and for some of the readers that are interested in like Warren Buffett books, for example, and they like to mimic, some of the approaches of the intelligent investor. There's this idea that you could arguably buy or make an investment and hold it effectively forever. What would you say towards kind of like a blanket statement like that?
Well, it's difficult. Buffett doesn't just buy and hold anything forever. Mm-hmm. If he's buying and holding something, it's because in his analysis, something is very low priced relative to its ultimate value. And so he's basically buying a mispriced asset. Mm-hmm. And as long as the fundamentals don't radically change, he'll hold it because that's the type that it's true, really, not just Buffett, but any value investor. And to take somebody, I could take someone that I interviewed, Joel Greenblatt, who sort of Buffett is a hero of his. Mm-hmm. I even sat in on one of his. It was a time he was teaching Columbia Business School class, and which he did because he enjoyed teaching. But the day I was there, he did a thing where he played Buffett. He sort of would talk and take questions. He took questions from his class and would answer them as Buffett would. But it became very confusing for the class and for myself because nobody could ever figure out whether he was answering as Buffett or as himself because there was very little delineation between the two. And,
some alter ego.
Yeah, so because it's really similar, but I can speak. So Greenblatt's approach is the same in that sense, and it's going. Investing in real value. Now, to be a value investor, you really can't do this type of stop we talked about. That type of approach is incompatible with value investing. It's totally incompatible. And in fact, Greenblatt had a really nice set of comments, which I think was cute but very, very true, and maybe the most true thing you can say about value investing, and I hope I can get it right here. So say, number one, value investing works. Number two is value investing doesn't work all the time. And number two is why number one works, is true. So in other words, if you didn't have the occasional 99 to decimate value investors, then everybody would become a value. Everybody would just do it, and it would self-destruct as an approach. But because value investing does go through periods where the market is irrationally priced for lengthy periods of time, and only if you are a real, true value investor can you ride those things out and come out ahead, is why it continues to work. But it's not an easy thing to do, and you have to be very savvy about it. And in the wrong hands, it could be lethal, obviously, because there's a difference between being a value investor who really understands the fundamentals and knows what they're doing versus being somebody who says, well, I'm a value investor, and I'm going to stay with it into a company that ultimately goes bankrupt. So there's a distinction here. I'm saying if one has the knowledge and the understanding to do a true value approach, and you are really a very savvy and talented and smart value investor, then there are times you will have to hold through periods where the market is where you're taking a substantially large loss, and any type of risk management would have had you out of that based on the loss. There's a great example of that occurred. I don't know if you read Hedge Fund Market Wizards, but in that book, Martin Taylor, who primarily was an emerging market manager, and as far as I know, has the best emerging market record ever compiled. But as he went on, he also eventually started investing also in developed country stocks as well. So he did both, and his portfolio was a mixture of the two. Concentrated investor, usually maybe only 15 positions, maybe even less. When I was there, when I interviewed him, he was in the process of returning. He was managing about $7 billion, half in a hedge fund, half in a long only, and he was in the process of returning it all to investors because he didn't want to be bothered, staying within what institutional investors wanted as like strict guidelines, like never lose more than 6% of the month or whatever. Mm-hmm. And he gave me the example at the time that his single largest investment, which was causing his entire loss at the time, was Apple, and this was an Apple before the split, and it had gone down from about 400 to 350 right before I interviewed him. Mm-hmm. It was a 350 when I was interviewing him, and he went on to explain all the reasons why he was like, I never heard anybody more convinced fundamentally about anything than he was about why Apple would go higher and why the street was wrong about all their expectations. And the crux of the argument was essentially that the street was extrapolating earnings. They were totally missing the boat that a large amount of earnings in the future would be coming from offshore, particularly China, and they were not their earnings estimates were not factored. Their projections were not factoring that in. And if that was factored in, Apple was ridiculously underpriced. So there was no way in the world he was getting out of it. And the stock more than doubled in the coming year. And I think that when I interviewed him was probably not too far from where the low was. But that was a good example. He had taken about he was down about 15% on a drawdown, which was almost all Apple, but he just was, there's no way he was getting out of it. He's a perfect example of a value investor mentality, but it's also an example of somebody who really, really understood the stock extremely well. And the same would be true, obviously, of Buffett and people like Joel Greenblatt. So it's a different type of It's a different type of world. Value investing is different than other types of trading.
I've always felt as if there was a bifurcation between a value investing approach and a price analysis approach. I've heard some interesting examples so far. Do you know of people that have been able to successfully merge those principles together to some extent? I feel as if the industry is missing some kind of, just like in science, there's missing kind of like a general universal theory that kind of addresses both to some extent.
When you say price analysis, exactly what do you mean?
Being price sensitive to some extent, being able to, okay, so despite liking Apple, if there's a drawdown of 15%, you're still going to sell without being dogmatic about your valuation analysis.
Yeah, and I don't think you can, like I say, hey, this is my opinion.
Okay.
Maybe I'm wrong, but from my experience and from what I've seen, I would say that those are just incompatible. That if you are going to be a true value investor, if the only way to really control your risk, you can't do it in traditional ways of like if this point is hit or whatever, because what you'll end up doing is getting out of positions like Apple at 350 or 360 or whatever it is, right before it really goes up a lot. So it's not an easy approach to use. The only way to control your risk in that situation is by limiting the amount of your portfolio to any particular position. So you can stand losing everything, but of course you should never lose everything, because if you are truly a value investor and who knows what they're doing, then you shouldn't be in any position that can go to zero. You shouldn't be in a position that can go to bankrupt. It should always be something that has real inherent value, and it's limited to how much it can go down. But you should be able to absorb a 50% loss, which can happen, say, in a bear market or something like that, as long as the fundamentals haven't changed. That doesn't mean that you save everything all the time. Surely, the people I've just, we've talked about, Buffett and Greenblatt and as examples, and Taylor, they all will get out of positions, but they'll get out of them because something has changed. They no longer like the position because there's been a fundamental change.
Jack, in your opinion, who is the wizard amongst wizards? Who in your opinion, is the greatest investor or trader that you've spoken to so far?
Well, there's lots of different approaches and lots of different people who are great, so it's in some of it's apples and oranges. It's really hard to compare. You got great option. Like something like a John Bender was a phenomenal option trader, brilliant. Somebody like Marcus. What's that?
Why was that?
Oh, well, first of all, his approach was, his basic philosophy was that the option market, obviously, this is it's not a philosophy, this is a reality, is the option market works and prices itself, so it's always assuming neutrality. The option market is generally neutral between, our prices could go up X% or down X%, because no matter what's happened before, because that's just the way it assumes that there's a long distribution around prices, and arbitrage are going to keep prices roughly in line. Different models will give you slightly different numbers, but it's not going to be grossly different. Mm-hmm. Bender's understanding was that may be the way the models work, but the reality doesn't work that way. A log normal distribution doesn't describe really how a specific market will work. It may be a good approximation sometimes, or maybe often, but there are many times it isn't. So, for example, in our interview, One of the examples he gave was, let's say, the time gold. I forget where it was, but let's say gold was like at 400, if I recall, or it was a little over 400, low 400s, and so his belief was that if the market penetrated this critical level by something meaningful like 390, then it would cascade down, and so. Now, a 385 option would assume that there's a very, very low probability of getting the market coming to that price. But he understood that if the market went to 390 or 395, or whatever it might be, maybe not 390, 395, then the odds of 385 getting it would go up dramatically more than the tail probability of a log normal distribution would apply. So what he was always doing was looking for situations where the market was not accurately allowing for a potential tail type of move. And in fact, he made a fortune on the bear market in 2000. When I spoke to him, it was 1999, and he was positioning himself puts for a bear market. And so that was a sort of classic case of where he was assuming the market was not really accounting for the risk that was inherent. For that a large move was much more likely than the option prices were allowing. So he basically kind of did triple-digit returns in multiple years. But then you have somebody like that. You have somebody like Michael Marcus who had his run when he was at Commodities Corp, who took a $30,000 account into over $80 million in a dozen years. You've got people like Marty Schwartz in his heyday, where he was averaging 25% a month, literally just trading S&P futures for like 10 years on almost. Of course, these things they're not able to sustain that type of thing, but even so, I mean, just for that period, it was just extraordinary. And then you have people like Thorpe, who probably has the most incredible record of anybody interviewed insofar as his first fund, let's take his first fund, which was 19 years running. 19 years, 19% compounded return, but that's not the element. The element is that he only had 3 losing months in 19 years, and they were all under 1%. And that is while compounding at 19%. So that type of track record is sort of, if you want to run the probabilities on that, I actually did it for the book, and I think I came up with the analogy that it was as likely to get his track record by chance as it would be to pick an atom from the mass of the Earth, not the surface, but the actual physical mass of the Earth, and then to randomly pick the same atom again. That's would be in the same rough. Actually, that would be a higher probability than Thorpe's record. So.
Yeah, I'd imagine you, in your own personal portfolio, have had some very big losing months based on having these conversations with these guys, at least when you were initially doing this, hearing their approach, their school of thought, seeing what you could implement on your own, but then talking to another individual and actually getting a little confused about, what you would do in your own portfolio. I'm assuming that happened.
Well, the thing is, if you think about it, one of the things, and I think you read the books carefully, you'll see one of the strongest things I emphasize, and I do it also when I give talks, it's probably the first major point I make when I give talks about the market was a theme, is that it's critical for people to find their own path, that there is no magic formula. So, I believe that for a long time. So even though I can interview somebody like Thorpe, who's a brilliant mathematician and started out as a field in physics, but and who continually in his career came up with inefficiencies in the marketplace. Now, I couldn't duplicate what he did anyway because I just don't have that quantitative. It was actually a combination of both quantitative ability and the creative insights. But anyway, it's a talent and it's a skill, and it's there aren't too many Thorpes around. So that's it. Or like a Michael Marcus who I knew personally and was a friend, and for a while we used to get together for lunches. When he was in New York, and I know from speaking Marcus with him that he would look at the same markets I did, but he would just have this understanding about what was critical about a certain market at a certain time. And I could look at 100 things and not know that the one thing that was important, but he would. And that was, again, not because, and he wasn't particularly analytical, and I was, but he just had this kind of intuitive sense of what was important to the market. So these different people had different skills, which are not necessarily replicable, but what is important is certain things that they have to say. And a lot of times it comes into the scope of risk management and stuff, but there are are things that they say that you can relate to your own approach, whatever it may be. But the thing that I always stress to people is that it's important, whatever you do, you don't try to take it off a silver tray with somebody else. That's not going to work for you. You've got to come up with your own approach. So I actually didn't try to duplicate other people, but more so just try to pick out those things that, and there are things I emphasize in the books as well that I thought were important lessons, which could be applied not necessarily just to their own approach, but might have much broader scope.
Well, Jack, it's been a real joy to talk to you about all this stuff. Maybe sometime we can talk more about that book that not everyone knows about.
Sure.
And maybe there's what other interesting chapters are in there, by the way?
Yeah, well, I basically, so the idea of the book, as you can tell by the title, is to try to dispel misconceptions people have about markets and stuff. So, so the efficient, like the what I call, by the way, that chapter is called the deficient market hypothesis. Then I have a chapter on which goes to the heart of explaining why one of the biggest mistakes investors make is to believe that past performance is the way you pick investments, and why choosing things on past performance is extremely wrong-headed, and actually, and there are certainly a number of instances where doing the opposite actually works better within certain guidelines. So
what is the real-time indicator for that then? Because if you're trying to assess someone's ability, what can you use?
Well, okay, so it's not just that. That didn't mean necessarily just, there are certainly individuals who maybe can do better and stuff like that. But what I was addressing really was the tendencies of people to, let's say, flock in and out of the broad markets when, like like now the market has been doing well, you're getting more and more people investing, but of course in 2000, 2008, and 9, end of 2008, 2009, people were going the other way and they wouldn't go in the market, no matter what. So this idea that you can on a market basis, the worst, if the broad market has done poorly, and I did an analysis in that book, I showed how the relationship between past 5, 10, and 20-year performances, how you really wanted to invest during post-bad periods as opposed to post-good periods. Then you have it on sectors, and I looked at sectors using the S&P sectors and showing how comparing the strategy of picking the worst sectors of the recent period versus the best. And showing, like people flock to what have been the best performing sectors, and showing how actually on a return risk basis, the worst performing sectors are actually better. And the same thing on hedge fund strategy. If you look at hedge fund strategies as sectors, again, it's the same type of pattern. I did the same analysis there and showed the same types of results. So it's just the idea that but of course, within any sector, within any if you're picking an individual manager, that doesn't mean necessarily that a manager who's done particularly well is going to do poorly, but it's true on broader markets and sectors and things of that nature, which is the way most people invest. And then I did a thing on expert advice and examples of why that's not a good thing. You don't want to be listening to the experts. I did a couple of chapters on risk management related issues. On track record pitfalls, all the things people do wrong about analyzing track records, correlation misconceptions, portfolio diversification misconceptions, and basically a lot of issues of that type.
Well, I'm going to try to get a copy of that, and maybe next time we can discuss more into detail about that.
Sure. I mean, there's lots of stuff there lots of stuff there for I actually had given 2-hour workshops on that book, so
Oh, really?
there's plenty of stuff there. Yeah.
Okay, I'll check that out. So Jack, thank you very much for coming on. I hope we can do this sometime in the not too distant future after I read
it was
the
fun.
book.
Went into some different areas, which is always good.
We hope you enjoyed this mastermind session. If you'd like to contact Peter Pham or Phoenix Capital, please email info@phx-cap.com.